Fed Chair Jay Powell begins 2 days of congressional testimony on Capitol Hill today, his semi-annual report to Congress on monetary policy, with everyone scrutinizing his every word for indications of whether and to what extent the Fed will resume loosening monetary policy. We welcome now from Capitol Hill one of those who will be asking the questions. He's Senator Pat Toomey, Republican of Pennsylvania, and he's a member of the Senate Banking Committee. So, Senator, welcome back. Good to have you, sir.
Good morning. Thanks for having me.
So let's get right to it with Chairman Powell. The markets, we can show a chart, so the markets think that we're going to have at least one rate cut this year and at least two by next year. Where do you think we're headed?
Yeah, well, I'm not sure, but I get the market consensus is pretty overwhelming for at least a modest rate cut in the near future. When the markets are this convinced, they are usually they're not disappointed. Look, I think it's actually a little bit of a closer call than what the market seemed to suggest, because while certainly we've had a deceleration of growth, I think the fundamentals still look pretty good in the United States. On the other hand, around the world, they look much less good. And there certainly are increasing risks, especially on the trade front. So you know, I won't be surprised if what the market has priced in actually comes to pass. But looking further down the road, it's very hard to know.
What do you hope to learn from Jay Powell, the chairman, from his testimony, and particularly about how he's approaching this, what he's looking to?
Yeah, so that's the right question. You know, I want to understand better how the Fed thinks about this very strange world we're in. How does the Fed think, for instance, about bond yields and the fact that the entire yield curve out to 20 years is trading well below the Fed funds rate? How does the Fed think about the effect of the European sovereign debt markets, all of which are, in my view, not all, but most of which are absurdly trading below zero in yield? How does that affect the U.S. bond market? How does that affect where the Fed funds rate should be? What do they think about what the neutral rate is? Clearly, it's lower than we used to think of for a neutral rate, but what actually is it, and what guides your thinking as to how to determine that? These are some of the things that I'd like to understand better from the chairman.
And as you know well, trading goes up, trading goes down. The bond market might do things for various reasons, but how do we sort out the extent to which the bond market really is reflecting a deeper underlying concern about the global economy, and for that much the U.S. economy as well, how strong we really are?
Yeah, well, that's one of the challenges, right? I think it's very, very hard to parse out when the 10-year is yielding today, and maybe it's at 205 or wherever it is. No, historically, the 10-year has sort of roughly tracked the expectations for nominal GDP growth. I don't think the market is saying that we expect average nominal GDP growth to be 2%. So I suspect, you know, Pat Toomey talking, that part of this is the fact that central banks around the world are buying massive amounts of sovereign debt and distorting this market. But you can't prove that, and it's one of the dilemmas and one of the challenges that the Fed faces.
So let's assume you're right that they're distorting the market to some extent. Do we need to catch up with them? Do we have to keep up with them? Because the President of the United States seems to indicate we should be. I mean, he's come out more than once and said he really wants lower interest rates, and there are reports today that he's even talking to his people about how we can weaken the U.S. dollar.
Well, presidents generally prefer lower interest rates. I get that. But lower interest rates are not always the right remedy for the economy. I think we can't ignore the bond market, and our bond market is not subject to the direct distortions that the Europeans and others are, because our Fed is not out buying every treasury in sight anymore. They were for a while, right? So I think that has to inform our judgment. I think macroeconomic numbers have to inform our judgment. We had a strong first quarter, surprisingly strong, right? But I don't think anybody thinks that the second quarter we're growing at 3% plus. On the other hand, we just printed a terrific jobs number. So, you know, this is why these guys have a really tough job.
As we listen to Chair Powell, none of us can forget the fact that President Trump has raised some questions about his tenure, has really questioned the job he's done, and he said more than once, I can fire him if I want to fire him. What would your reaction be if, in fact, President Trump tried to remove Chair Powell?
So I think that would be a very, very bad idea. I don't think the president actually does have the legal authority to do that. It would be a bad idea in any case. Look, I think if you step back and you look at what Chairman Powell has done, he has done us an enormous service by overseeing and managing a process of normalizing interest rates. You can argue that maybe they went up a quarter point too high in December. Okay, fine. But there's no question that we are closer now to normal, neutral rates than we were for like a decade after the financial crisis. And I think that experiment with zero interest rates and massive bond buying was very dangerous. So on balance, I think the chairman is doing a great job. He's managed this process really relatively smoothly, frankly, more smoothly than I thought the exit from QE, whatever we were up to. And now he's looking at the data and contemplating which direction we go from here. No, I think he's doing a really solid job, and I'm hoping he'll stay right where he is.
One of the things he said is he wants to do whatever he can to extend the business cycle. If he can't do it through monetary policy, is there room on the fiscal side up in your neck of the woods?
Well, see, what I think we've done is we've created an expansion on the supply side, right? By lowering rates, by allowing the expensing of capital expenditures, by rolling back regulation. We've expanded the supply side. That expands the productive capability of our economy, and that's why we're getting strong growth without inflation. That's exactly what we want. The traditional business cycle, you know, the academics would have it as an inventory buildup, right? That would get too big and then had to be worn down. I think with just-in-time inventories and global supply chains that are enormously efficient, I think the inventory-driven cycle is much less of a phenomenon now than it was, you know, some decades ago. And so I think it's entirely possible that we could have very strong, sustained growth for a very long period of time if we get the policy right. I don't think we need to throw a lot of cash at it from Washington. The economy is fundamentally okay. I think we want to keep good tax policy, continue to roll back excessive regulation where we can, and sensible monetary policy, and we'll probably be in good shape.
Okay, Senator, thank you so much for your time today. Really appreciate it. That's Republican Senator Pat Toomey of Pennsylvania.